Right, the music is off. So let me introduce my excellent panel to you. On my immediate left is Dirk Forrister. He's the president and CEO of the International Emissions Trading Association, better known in the acronym, I guess, IETA. On his left is Dr. Yue Tan, who's the board secretary and head of the Beijing office of the Tianjin Climate Exchange. And then on his left is Philippe Lacamp, who's the head of sustainable development at John Swire & Sons. I guess for those of you who are from Hong Kong, you'd be familiar with Philippe. Now, I have another panelist who's going to be beamed in very shortly by video, who's, of course, Dr. Richard Sendor, and he's the chairman and CEO of Environmental Financial Products, LLC, but previously as the founder and incubator of the Chicago Climate Exchange. So I thought what I would do today is just let Richard be beamed in. Richard will be talking to us for about 10 minutes on a sort of broad picture, and then I think we'll take the conversation from where Richard takes us. So if that's okay, can we have the video, please?
It's a pleasure to be here with all of you today at the first Investor Forum on Climate Change. A particular thank you to my friend Tessa Tennant, who facilitated this address. In the 1980s, the United States was racked by acid rain and smog. Acid rain comes from burning of coal and sulfur emissions and NOx that go into the air, combine with water, and cause the deadly effects. In a radical approach, in 1990, the United States Congress passed the Clean Air Act of 1990. It was the first widespread implementation of what is commonly known as cap and trade. The program was an incredible success. Acid rain and smog disappeared from those cities that they existed in during that decade. Total sulfur emissions in the United States went from 18 million tons in the decade of the 80s to 3.9 million tons last year. The medical savings alone last year were $170 billion. That's annual savings that come from reduced medical expenses associated with lung disease. Moreover, there were 35,000 lives saved in that year as well. This program, by any measure, has turned out to be, from a cost-benefit ratio, the most successful environmental program in history. While there's a lot of talk, and particularly in the capital of the United States, that cap and trade is dead, I'm here to tell you it's alive and well. It's alive and well, and there are 55,000 contracts of open interest, outstanding agreements to buy and sell on renewable energy certificates. Last week we traded the first solar renewable energy certificate on ice in New Jersey. And furthermore, we have RGGI, the Regional Greenhouse Gas Initiative, covering carbon emissions in the Northeast. But most importantly, California represents almost half of what is traded in the United States. California, as many of you know, is a trendsetter. It's a trendsetter in social media, personal computers, iPads, searches. It's also a trendsetter in the environment. And we believe that California could set the way and be expanded to become a national program. At 25,000 open interest and 9,000 futures, the California market, after only 5 months, is bigger in futures than lumber, oats, which are mainstay old line commodities. Furthermore, that program is going to be extended to Quebec, so it will become international. And the governor of California recently made a deal and signed an MOU with the government of China. So look out for California, and also look out for China. Just 5 days after this conference, the city of Shenzhen is going to be the first to launch a trading in CO2 emissions, the driver of global warming. Furthermore, there are 5 cities and 2 provinces that will join them in the short term, in Shanghai, in Beijing, in Tianjin. So be careful of the axis of China and California to lead the way in environmental movements. It's not only China and in Asia. India has an energy efficiency program and a national renewable standards portfolio. There's also a pending program in Korea, Japan, Kazakhstan, Mexico. So the notion of the demise of cap and trade should be dismissed because of what may be coming over the horizon. The granddaddy of all the programs is the European Union ETS. If you Google that today, you'll see hundreds of articles criticizing the European Union, but they all focus on price. Price is not the right measurement of the success of the program. It is a signal that generates behavior. Europe was supposed to decline by 8% in accordance with their own mandates. They went down by 17% in carbon emissions, well beyond their own standard. Everybody, or many, say, well, that's because of the slowdown. Well, if you look at the data, that's not true. The GDP of the European Union is now higher than it was before the Great Recession. The fact is that carbon emissions have dropped because people have switched fuels from coal to gas, instituted energy efficiency programs, and prices performed well. We don't get upset if high prices in wheat generate huge crops. We're happy with that, actually. And the high prices initially in the program change behavior. There is a question, and a reasonable question, that should be considered for open debate. Is the price high enough to generate further reductions in CO2 emissions? That is the subject of legitimate debate, and it could be addressed, for example, by tightening the reduction targets well into the future so the current economic slowdown is not affected. It also could be done with things like price floors. That's the way California is doing it. So there are fixes if we want to look prospectively, but looking back, the program has simply worked and done the job. Let me address in the final moments of this talk what I think will be the most important commodity of the 21st century, and that's water. It is the oil of this century. Basically, there are only 3 continents that are long water: North America, South America, and Europe. Africa is short. India is short. China is short. Water quantity and quality is the next most promising way that we can use markets to address important social issues. While we today really have surrogates for water trading, for example, a bushel of wheat is 155 gallons, chicken costs 500 gallons, and a steak is 1,800 gallons. We trade water through grain trading and food trading, but it's not an efficient way. If we're going to use markets to address social and environmental needs, we have to turn our attention to water. Thank you all very much, and it's a pleasure being here virtually with you.
Okay. Now, I did expect Richard to be a bull on cap and trade, and I also expect, Dirk, that you're going to be a bull on cap and trade. But there were a number of things that Richard said that I think it's worthy for us to examine. He's saying that price really is not the issue, and whilst everybody may say EU ETS is it's on its backside, he's saying no, it's done its job. Secondly is he talked about the excess of California and China, and I'm sure David can address that. And then, of course, I think afterwards, Philippe, my question to you will be, as a businessman who is very concerned about sustainability, and your company is a leader in this field, what does any of this really mean to you? So perhaps, Dirk, you can let us know whether you're a bull or a bear.
Well, I certainly share most of Richard's views, and he's a dear old friend. I wish he could have been here in person because he's such a dynamic speaker. I know he would have added a lot to the discussion. I go back with Richard to the acid rain days in the U.S. I was a congressional staffer working on that bill, and he was one of the people that we would trot in from time to time to sort of build confidence with legislators about this new concept. And later, when I worked in the Clinton administration, we brought him into a session at the White House, a conference at the White House before Kyoto, again, to talk about the same concepts. And so it's good to see his face up there again. He's right that carbon markets are taking hold in a lot of new and interesting places, and they have not seen their last day by any means. And I guess as I look at the European system right now, obviously that's a place where my organization has strongest dose of its membership. We do recognize that the program is meeting the goals that were set out for it environmentally, but it's sort of meeting the lower end of the range. In Copenhagen, Europe committed that it would achieve between a 20 and 30% reduction by 2020, and that would be on a trajectory to getting to a long-term ambition that was somewhere between 80 and 95% below. So one of the things I think the business community, and certainly my membership, is struggling with is that we know that the trajectory they're on right now is the easier end of the range. So everyone knows that the cap will be tightened again in time. We just don't know how soon and how aggressive that reduction schedule is. There's a big policy debate underway right now, but if you were to take out, if you were to sort of forecast that 20% reduction, it has Europe aimed at roughly 70, 71% below by 2050. So they're not on the path that they intended to be on, but given all of the economic struggles in Europe right now, that this is about as far as they're willing to go. So there's discussion about structural reform that I think is very healthy, and some of the ideas Richard talked about in the video are ideas that are on the table. Everything from setting aside some of the allowances into a reserve, sort of a rainy day fund for the future, to institution of a price floor or possible other structural adjustments. Just frankly, my membership is most interested in actually defining the cap, what it needs to be going out between 2020 and 2030, which I think would send a strong signal to the market that would change pricing. Right now, that uncertainty has played a large role in sort of diminishing the price that we see traded in Europe right now, but I don't think it's going to stay there. 2 weeks ago at Carbon Expo in Barcelona, we released a market sentiment survey that we at AIDA do every year with PwC. And our members chose an average range over the course of the next 7 years of this phase of the EU ETS at more like 10 euros a ton. And I think that's showing an expectation that there's going to be some change in policy that's going to send a stronger signal of how much mitigation is going to be needed across Europe. It also showed a strengthening in the pricing of CERs, and I'm not sure what all is baked into that question. They showed that prices would rise to as much as 5 euros on average over the next 7 years. But I think it has something to do with an expectation of Australian demand coming in, possibly of some Chinese demand for Chinese CER that takes something out of the mix, and certainly an expectation around aviation because of moves in that sector to possibly recognize international offsets. So on the whole, I think we're in a period right now where the reset button is about to be hit on the EU ETS, and that we'll have a stronger price signal coming out of it that is aimed at a greater degree of ambition. The other important thing that's happening, though, around the world is another theme that Richard started on, and I'll amplify, is that carbon markets are taking off in a lot of new places. We're seeing the RGGI program in the U.S. Tighten its targets, make some structural reforms so that pricing is improving in RGGI. California has officially started this year. Australia is coming up on its 1-year anniversary of a fixed price phase, but leading into a carbon market in years to come. And probably our membership's greatest attention is turned on China and on Korea, where it looks like new markets are taking shape. And I'm not going to talk, with David sitting to my left, I'm not going to talk much about China because he'll have a lot more current information than I do. But one of the things that I do think is important for the business community is that we engage in these new markets to help bring along the business side of things so that we have good practices across international borders. And ultimately, my membership's interest is in seeing connectivity between these systems. So we hope that they can develop in a way that is harmonized enough so that ultimately they can link together. Because if policymakers are serious about ambition levels of 2 degrees in terms of limiting warming, and possibly 450 parts per million as the ultimate ambition internationally, we're going to need smooth global markets to operate so that capital can move around to the places on the globe where it can do the most good, and a sort of a globally connected carbon market, we think, is part of that. So last year, maybe the most important policy development of last year was the announced linkage between Australia and the European Union, at least as far as AIDA is concerned, because I think it's going to give us the first model of how that connectivity could take place at a national level. But we're also watching very keenly how California and Quebec link their systems, and what terms and conditions apply to that, and sort of in terms of the governance of it, how will it operate. So it creates, I think, a lot of interesting prospects for investors, because these pricing signals should send some interesting new dynamics into the investment community. And I want to thank the organizers of this event for including markets as part of the discussion, because I think our communities need to talk more about how climate finance and carbon markets intersect. We have a huge new opportunity coming along with the Green Climate Fund. It could be very competitive with carbon markets and send inefficient signals, or it could be designed in a way that reinforces and helps carbon markets be more effective, and certainly I'm hoping for the latter. So I think I'll stop there, but those are some of the themes of things that we at AIDA are working on right now, and that I see as interesting trends around the world.
Well, I'm sure people will want to put questions to you. Well, David, perhaps you can tell us what's going on in China.
Sure. Well, first of all, my great pleasure to be here, and I want to congratulate the organizers for their very good choice of background music back in that room. Well, to me, a combination of Tchaikovsky's Symphony No. 6, The Passion, and Beethoven's Symphony No. 3, Eroica, is the best characterization of the climate change issues here. Optimism and pessimism. And I actually had a private agreement with Dirk that if he is going to be the optimist on this panel, I will be the pessimist, contrary to what I should be given my institution of affiliation. Well, to me, I'm not as optimistic as Dr. Sander and Mr. Forrister on this carbon market development, for the reason that, to me, looking from afar at the European market, seems that the greatest problem is that a carbon trade system under an absolute cap cannot really take into account macroeconomic fluctuations. An intensity target might do a better job. Well, an absolute target will be best, and it makes the best sense environmentally because it matches environmental integrity requirements. But the European problem is that once the economic downturn is onset, it's very hard for governments to take back allowances from the market. Now, I imagine that it might be better if we have an absolute cap as setting the absolute limit, but we have an intensity target to set an effective limit. That's what China might be trying to experiment here. Because as you know, now I'm coming back to the Chinese scene, China is committed to an intensity target reduction nationwide, and that target has been broken down into provincial and municipal targets. And the country has committed to developing a carbon market, or many different carbon markets, during the next 3 years, and hopefully a national market during the 13th five-year plan, which runs from 2015 to 2020. Previously, rumors have it that a national market will be up and running by 2015, and I can absolutely tell you that that's infeasible. But if we look ahead into the 13th five-year plan period, it's more possible. In order to have a national market, we have to have good data infrastructure. We have to have a lot of capacity building at the local level. And we've got to develop rules and regulations for central trading. And all these are absent yet. Well, the meaning of the 7 pilots here struggling to launch themselves, well, Shenzhen is a bit ahead, and we at Tianjin, I can say, is like in the middle class of the social ladder of competition. All these, or I should say most of the pilots are trying to do experiments. And in these experiments, we are trying to review problems, as I put it, to the central government that there are lots of things have to be done before a real market can be functioning. We got to have good data, which is absent in almost every part of the country. We got to have reliable verification, and we got to have liquidity, which I think is the thing that's most concerned about with this audience. Now, for the next 3 years, we're going to see probably 5 to 6 working pilots in China of relatively small scale, local, provincial, or municipal markets, all doing only spot trading. No futures, no derivatives. And it's yet an open question how much liquidity there will be in the market. Of course, for instance, we at Tianjin, we encourage liquidity providers to enter the market. We encourage carbon funds, even banks and perhaps other kinds of funds, to act as market makers, even though market makers are explicitly forbidden to be present in the market for regulatory reasons. But we hope that a certain degree of liquidity can be provided. And with that, a meaningful price for carbon can then be formed in some of the pilots. But these pilots differ from each other in terms of their coverage, sectoral coverage, in terms of their scales, in terms of their rules for liquidity provision. So imagine that there will be many different carbon prices in China by the end of this year and certainly early next year. And the question will be, what does it mean to have these very different prices? They might not really reflect marginal costs of carbon reduction, but only differences in market designs. But then, by this revelation of problems, it's hopeful that the central government can develop a more effective and well-functioning national system, which can be implemented after 2015, and that's our common goal. Regarding linking with other parts of the globe, I think we're in good talks with California and Australia, and hopefully there can be progress on this front. But you are not going to see real linking before 2015. That's my personal hunch. Perhaps I should stop here, and then I will turn to Mr. Lacombe.
Okay, well, I'm sure we'll have a lot of questions for you too. Philippe, what does all this mean for you?
Yeah.
Somebody who's not developing the trading of this, but trying to see how they may be useful for your business.
Sort of on the receiving end. And we've had a little bit of experience, obviously, in Europe with certain of our operating companies in aviation. I guess I was trying to think of this from an investor perspective, and it led me to think about the importance of future scenario planning. And it's something that those of you from Hong Kong, I've talked about it before, it's something that we take quite seriously. If you are looking to invest, and hearing what we've heard, the three speakers before me, I don't have certainty from a commercial perspective yet. But it's pretty clear that something's going to happen, and something's going to happen that's going to impact our operating companies. So from our perspective, the notion of pre-compliance is pretty important. We don't know the details. There's going to be, as David says, a multiplicity of prices, but clearly at some point in the future, and if we punch out 10, 15, 20 years, we know we need to know about carbon markets. We know we need to understand the opportunities within those carbon markets so that we really shift it from being a liability into a commercial opportunity. The one thing that, as a commercial enterprise, we don't want to see is this patchwork quilt, which again is a common used expression amongst many of the industries that are potentially impacted by the differing schemes globally. So I think we're delighted to see this potential confluence as it comes together. It is confusing for us, so to make it as simple as you can in the terminologies that are required by businesses would be very useful. But I think, again, from an investor perspective, I would rather put my money behind organisations and companies that are engaging and thinking about these markets than those who are basically taking a wait-and-see approach. So from a pre-compliance perspective, we use that to drive internal behaviours. We have set up data systems. David, you talk about the importance of data integrity. That was clearly important for us, both from an external perspective, we can see that it will be required, but also if you do your data collation well internally, you will identify efficiencies in your operations, etc., which obviously everyone in this room will be familiar with. And I would link that with the final comment that Dr. Sanders threw out there about water. We think a lot about water. There's a lot of exposure, a lot of potential liabilities around water. So again, if we can use what is happening in the markets, the carbon markets, as some form of benchmark internally as to how water might potentially be traded as well, then again, from a pre-compliance perspective, it makes it much easier for me as Mr. Sustainability facing all of our commercial drivers within the organisation to say, look, this makes sense. It's a good investment of your time. It's a good investment of an element of resource to understand these markets. And then obviously in a conglomerate like Swire, we have potentially opportunity to develop carbon credits, water credits, energy credits, whatever those are going to be longer term.
Okay, excellent. Your questions, please, ladies and gentlemen. Comments, questions? Yes.
Robert Gibson, City University. One specific question for Dirk. The Australian scheme, as I understand it, they're going to have a fixed price escalating by 5% a year for 3 years. They get up to 25 Aussies and a bit per tonne. And they were then expecting to start trading with Europe. Well, 25 Aussies per tonne isn't likely to equal 10 euros. How is that going to work out?
Actually, I think as I look at it, the time frame that they're thinking about linking up is a period where they'll be going into, yes, you can go in and buy EU allowances that I think some Australian firms can do now and maybe are doing. Good prices there, and you can bank them and hold on to them in an EU registry account to transfer later. Some risk about whether that transfer will be able to happen on a schedule that you want, but at, again, current pricing, maybe it's something apparently that some of them are testing out. But by the time that the systems actually connect, the Australian price will move into a market-traded price. So I think the expectation is that it will get substantially lower. At one point in time, they were thinking about a price floor that's been eliminated in part because of incompatibility with the EU. So the other expectation is that the EU price will strengthen over that period. So my suspicion is that maybe they won't be quite as far apart as they are today.
Yes, please.
Just a couple of questions for David. With the regulated electricity market in China, the emission compliance companies won't be able to feed their carbon costs into the price. What are they going to be doing that on the trading side? Secondly, is there an unfair pressure on China regarding carbon trading? There's a lot of global carbon traders from Europe and from America all looking at China at the moment, whereas from my understanding, China is pretty much an emission monitoring capacity at the moment, for the next 3 or 4 years, will be that way. So looking for China to be the saviour for the carbon markets seems to be a little bit unfair on where China's stage is at the moment. And with Australia...
Can we have maybe just 2 questions at a time?
Yeah,
be easier.
Okay.
Because I could hardly follow your second question, so I just want to make it easy for everybody. So David, do you want to take those 2 questions first, and then maybe you can re-ask your question for Dirk?
Well, I'll offer a short answer to the second part of your question, and I'll take the first part in detail. The short answer is that China can never play Jesus Christ, that's for sure. And as I said, you can't expect there to be great things happening next year. We have to look into the medium term. Well, for the first part, it's a very, very good question. I don't think a lot of researchers around the world, especially European researchers, I must say, have taken very detailed look at these institutional infrastructures in China. For instance, the regulated power prices, which will have a very huge impact on market design. Now, for the reason that power prices are regulated, and moreover, very often they're fixed by powers on high, the power plants upstream can't really pass the pressure down to the downstream players. So if we follow the EU design of allocating allowances entirely to the upstream plants, expecting them to be able to share the burden with the downstream partners or customers is unrealistic. So in our design, we explored several different options. One is that we follow the EU way, but then just to give the upstream power plants a very loose allowances, a very loose cap. The other way is that we look at upstream players and ask them to account only for their self-used electricity, which essentially eliminated the power sector from the market. The other way is that we eliminate the power sector and then we put all the pressure on the downstream players. At the end of the day, out of a very complicated process of unspeakable determination, we decided for all the pilots in China, of course there is an official reason behind it, to do it in a hybrid way. So we're going to allocate allowances both to upstream players and to the downstream players. The power plants will be responsible for the entire direct emissions, coal consumption, direct emissions, there will be allowances for them. And the downstream players will be responsible for both direct and indirect emissions. Now, of course, the natural question, the academic question is that there will be double counting. Yes, there will be double counting in the number of allowances to be allocated, but the number of allowances will exceed the effective cap in these pilots. So think through that is almost like a way to circumvent this issue. We don't expect a price mechanism in the power sector to transmit the pressure between upstream and downstream, but then we create a design so that both the upstream players have an incentive to reduce carbon emissions by improving their energy efficiency, as well as giving downstream players some pressure to reduce their electricity consumption. So that might be a Chinese invention here.
Does anybody wish to come back on clarifying or asking further questions on this point about the Chinese experiment? If not, do you want to ask the third part of your question, Shane?
Yeah, sure. Yes. Regarding Australia, the current opposition leader has said he's going to repeal in blood the carbon trading, carbon tax that we've introduced how do you think that will affect carbon trading or carbon markets globally moving forward, or no effect?
So I guess it depends on what he replaces it with. If he indeed has the votes to get rid of it entirely, I'm not convinced that he will. I guess we see how all of that plays out. But my understanding, and you may be closer to that market than I am, but my understanding from our observations of it is that the carbon farming initiative is something that's popular on both sides of the aisle, or with virtually all parties. And the alternative that we hear most about is that they might create a government purchasing facility to essentially what the Republicans in the U.S. would call it is socializing the whole system and having one big purchasing authority at a federal level. It costs a lot of money, and I'm not particularly, at least my experience with government procurement programs doesn't lead me to think that that'll be a particularly effective approach, but it is an alternative that might continue to keep a market element in terms of at least the offset side of things. But I think we do have to wait and see exactly how all of that plays out. I don't particularly like that model, but there may be ways to improve on it so that it is workable, but we'll see how it plays out.
Yes.
My name is Calvin Kwek. I'm from Greenpeace. I'm from China as well. I have a question, David, actually a follow-up question to what you just talked about regards to carbon markets. And perhaps this is outside of your scope of work, but there were rumors, first from the NDRC, a researcher saying that China might be thinking about a carbon cap in the next 13th, 50-year plan. And Swire came out saying that no chance of that happening. And I wonder whether you had any comments regarding that. Is that really a reflection of essentially a larger, deep-hearted, unspeakable, difficult conversation that the Chinese government is having about carbon cap in general, emissions cap?
Well, first of all, I don't have insider information. And second, even if I had, I can't share it with you. And third, I can share you the bottom of my heart. I believe that China has committed to an intensity reduction by 2020. So for all practical reasons, China is going to tell the world that we are going to honor that intensity commitment. At the same time, China is going to, I would say, promulgate an energy consumption cap. And, well, that's not for international negotiation reasons. That's for Chinese domestic reasons, because we are such a large energy consumer and it's unsustainable. So we have to cap energy consumption. And you can easily imagine that people can then gauge this energy consumption cap and imagine some kind of carbon cap related to the energy consumption cap. Now, whether the government is going to issue a real absolute cap on carbon during the 13th five-year plan period, I don't know. Some researchers, the more radical ones, are urging the governments to go down that road to accompany the energy consumption cap. But at the same time, for officials and for the government, take into consideration not only on this part, but also perhaps on negotiations, etc., that might not be very feasible for China. So I don't know. But if we have intensity targets for every province in China, if you have GDP forecasts, you can easily calculate for your own consumption and carbon cap for the entirety of China.
Any follow-up question on this one? If not, any other questions? Yes, at the back.
Dirk, you made a comment earlier, which was very interesting, that I don't think I understood, about the Green Climate Fund and how, as it develops, it could compete with markets or they could be complementary and reinforce each other. Could you elaborate on that a bit?
Sure. There's a lot we don't know about the Green Climate Fund, but I think when I think about a large new fund coming into existence at the same time that, I hope that the private sector fund side of it materializes just as quickly or more quickly, and there may be good collaborative models that develop. But my mind goes back to the early days of the CDM. And in the early days of the CDM, many of us in the market side ultimately found ourselves competing against governments and trying to purchase projects. We would also occasionally compete against the World Bank, which, when you're a small fund manager, doesn't exactly seem like a fair fight. And I think the World Bank didn't view it as a fair fight either, and ultimately they found their role trying to be more on the developing country side and representing, syndicating deals and that kind of thing. So we're now, I would just like to see us learn from that experience so that the structures that come out are truly public-private in nature, and I think it's terrific that they are involving private sector active observers on the board itself, and that they're intent on developing a private sector window that will attract private capital into the activities. But there's a lot we don't know about what the fund design is. One thing that I think might be interesting for the fund to consider as it moves forward is actually a direct connection with the existing carbon markets and looking at the deal flow that's available from the CDM of projects that are unfunded. Because there are a lot of projects that made it through the regulatory hurdles, but the market demand fell and they haven't found buyers or they haven't ever closed their investment. Not all of them are worth investing in, I suspect, but I do know that the Green Climate Fund is going to look more broadly than that. Yet I also think it would be great if it could demonstrate track record early on and get deal flow early on by some kind of a connection with what the CDM sort of created but is rotting on the vine right now.
Alex, do you want to follow up? Okay. Any other questions? Well, if not, then I'd like to ask a couple of questions. We talked about certain markets that are now there, REGI and EU ETS, and we talked about linking these markets with other markets. So in California, they're linking with Quebec. And David, you even talked about China talking to Australia and to California to see what linkages there might be. Now, I think we know the past experience in terms of the history of how, for example, REGI, I mean, obviously there are various states in the US and they've agreed to a set of trading rules. Now, when you then go from the US to Canada, okay, they're sort of fairly close neighbors. Maybe the systems are not so different. We're now talking about linking with Australia. But when China, in an early developmental stage, as they are today, pilot schemes already talking to California and Australia, what are these conversations like? And David, you said that perhaps nothing is really going to happen until after 2015. But what are the potential areas of linkages?
Sounds like a difficult question.
Or maybe we don't even have a shape yet. Is it just a kind of desire that if we can think of a trading platform, then we'd like to link it with somebody? But, knowing the other systems, how long it takes to, standardize things, how might China today, talking to a more established system that is already trading, how might that influence how the Chinese system might develop?
Well, in the short term, very minimally. Because it's even now not yet on the table to link the different pilots within China. So it will be even more a hurdle to try to link the Chinese pilots with California or Australia. Well, when I mentioned that there are such talks between these parts of the world with the Chinese pilots, I meant to say that the Chinese government is initiating such talks and with a positive attitude. So we're open. The Chinese government is open for future linking between the Chinese market, hopefully a national market after 2015, with some other well-functioning markets in the rest of the world. But I would say quite for sure that there will be no linking between these other markets with the pilots in China before 2015. If the pilots exist after 2015, then for the pilots themselves to link with these other parts of the world, we have to have central approval. And then at that time, there will be central planning of how to link the Chinese market, probably not these pilots individually, but the entire national market with California, Australia, or even the EU. But the central hurdle, or the greatest challenge, is, I would say, twofold. One is data quality, and the other is the way of cap setting and allowance allocation. 1 ton is 1 ton, that's the international principle, but how to convince the rest of the world that 1 Tianjin ton is 1 Californian ton is a big proposition. And the second thing is about allowance allocation. Given that China faces intensity targets, and we still try to guarantee that we have sufficient room for industrial development, because many of these pilots, as well as other parts of China, are still in the stage of rapid industrialization. We are not yet there as California or EU with a very mature, even post-industrial economy. So at this stage, we will have a different set of goals when we set the cap and allocate the allowances. So we have to negotiate this with the markets, the target markets, which we are going to link. It's almost like central banks have to talk to each other for monetary policies. I think that will take a lot of negotiations.
I guess the priority must be for the Chinese markets to find some way of linking themselves up first. Do you see that as a priority?
Well, I see 3 ways to go for these pilots. One is that they will continue to exist as pilots after 2015, but then they will broaden their coverage sector-wise. The other is that some of these pilots will link with each other and form cross-provincial markets, for instance, Beijing and Tianjin probably, or Guangdong and Hubei probably. And the third way to go is that the central government will scrap everything and then implement a national market in one shot. Well, that national market need not cover the entirety of China. It can cover the more developed parts of China and to let the rest of China develop projects, just like internal CDN within China. That can be one good way to go. And a lot of investors approach us trying to seek opportunities in developing projects, CCER, etc., for pre-compliance, compliance, or other purposes. I think because they believe that even if we have a national market, the project market in China will be very large. And that's also being seriously considered by the central government.
Any questions? I'm sure that was quite stimulating. Yes, Dirk.
On the linking front, what David's describing about China is really fascinating, and to think about the various ways it could evolve there. And I think the whole topic of linking is one that maybe it's come back to the fore recently because of this, on the international side, this possible linkage between Australia and Europe that may give us a model. But in terms of international governance, up until now, we've had a Kyoto Protocol that kind of gave us architecture to work with, where technically under Kyoto, you didn't have to have another treaty because you were linked via the Kyoto architecture, the Kyoto International Transaction Log, that kind of mechanics. And one of the things I find interesting about the Australia EU example is they may not be utilizing that architecture. They say they're working on a bilateral treaty that will define how their systems come together. And I don't think that bilateral discussion would have ever been possible if their systems hadn't grown up in the Kyoto framework of counting the same way, MRV in much the same way. Frankly, the targets were set acknowledging a sort of a similar level of stringency at the outset. So it gave comfort, I think, for this type of a linkage to take place. But going forward, this is, I believe, one of the big challenges we have in UN context is we're working on a new framework for various approaches that may or may not have that connectivity in it. We're working on a new market mechanism internationally that may redefine pieces of it. And it's not even clear yet what the UN's role in any of this would be. And the example I would give is if Europe and Australia do formalize that link and their registries are actually linked together bilaterally, and if they were to link with either China or California, my suspicion is that that sort of becomes the premier trading bloc that anyone else that wants to be a part of a serious international trading regime would need to be a part of. So it sort of self-defines the system. Or we, certainly we in the market would, I think, prefer to have more of that architecture worked out at UN level, but if it doesn't happen in 2015, it may happen this other way, sort of the de facto trading club of those particular markets that join up.
Philippe, I know you said that things are not certain enough for you at this stage, but having heard what's nearer home in China and all these businesses that you have, right? Your company has in all these other markets. Do you have any comments?
It's the reason we set up our carbon desk, because we know we need to understand and we need to follow the policy and the regulatory changes, understand the influences, and obviously we've got a fairly broad geography anyway, so to be aware of where we might be impacted or where there could be opportunity, for sure, that's one area. I think the one area of interest would be where we might be able to participate, particularly to David's point, a lot of these pilot projects in a non-punitive way could be, I think, quite attractive. How that would work out, I don't know, but...
this is an interesting point for us, particularly sitting in Hong Kong. Our neighbor in Shenzhen is going live on the 18th of June, albeit it's a small pilot. They've devised a way of measuring the emissions, so they have the data for quite a large group of Shenzhen-based organization. Tianjin, you are along the way, and others are going to come up with, schemes that, am I right, that sort of reflects your area. Shenzhen is very small, even compared to Guangdong. Guangdong is doing their own scheme, and you up in Tianjin, you're in a more industrial area. Shenzhen is sort of a city like us, but with a few more factories. Guangdong is different. So in a way, am I right in saying that these various pilot systems in China will all have certain characteristic that reflects their base? The idea, is it that they might join with their neighboring province or somewhere that kind of makes sense, so you have a bit more size, and after getting up and running for a few years, the national government is going to take a look and see what might be the next stage of evolution, even to the extent that they might chuck it all and say, okay, we know enough and we're going to define a project. Now then you have companies, and Philippe, in your case, you've got quite a lot of major companies operating in this part of the world. Are you saying that if you have a chance to kind of, again, be a part of the pilot as a business company, that you would welcome trying that in some way, but you don't want any penalties?
Yeah, if it comes with penalties, clearly the commercial case for getting involved disappears straight away. I mentioned the word pre-compliance before. We're lucky in our organisation that we have a tendency towards that way. There is a desire to be pre-compliant, to be ahead of regulation and policy rather than being dragged into it. One of the reasons that we may have slightly overpaid for the European ETS for aviation, possibly. I don't know. But again, it doesn't help the argument when you see that fairly disruptive change take place, then to have any potential financial impact would be difficult. But I do think that, as we sit and we listen to what is likely to manifest globally, what is certainly happening on our doorstep, I think it would be very pragmatic to participate. We disclose data anyway. We have an integrated annual report. We are very comfortable in the robustness of our data reporting and the fact that we want investors to know what it is we're doing. So I don't think, from that perspective, I think it's an open door. What the conditions would be to be a participant, I don't know. But I think intuitively we'd be interested.
I think it's quite interesting when you have somebody nearby who's starting a scheme. There are lots of Hong Kong investors or global investors that have investments in China, within these areas where these pilot schemes are starting. And I guess there's lots of Hong Kong companies that have investments both in Shenzhen and in Guangdong province. What are we going to do? What are Hong Kong companies thinking about, or are they thinking about what they might do? What kind of arrangements one can have with an exchange in China as part of that experiment? I'm not sure whether anybody in Hong Kong is thinking that way, but I certainly think it's quite interesting. Dirk, do you have any comments?
Well, I think there probably are companies here, and at least one that's one of my members that's thinking that way. I think there's a broad question about if and when the Chinese pilots want to attract in international companies, and it's something that a number of my members have assets there, and that's one of the reasons that they've wanted to engage more and to understand how the program's going to operate, and offering to willingly submit to be a participant in it so that they can learn from the start. But there's also a recognition that the systems need to walk before they run, and they may want to start with a more manageable sized approach. But I do think that ultimately it'll be a healthy sign if the China pilots are broad enough to include assets of international companies that are active there, so that builds more of a true market feel to it.
David, do you think it's possible?
Possible for participation?
In terms of foreign assets being able to participate, because I guess right now, for example, in Tianjin, they've identified a number of participants. For example, in you developing your system, do you foresee that in future it's possible to include foreign-owned enterprises?
Well, I can answer this question in two steps. First of all, our scheme does cover foreign companies. So there are certain companies, because they fall under our coverage, so they will be included in our ETS in Tianjin. Secondly, we do welcome foreign trading companies to provide liquidity to our market, but subject to subsequent regulations to be approved by the relevant authorities. And I believe that foreign participation in these pilots will serve as kind of provide some kind of leadership, because I must assure you there are lots of companies in China are very reluctant to trade for obvious reasons, because of the internal structures. They're not very used to using the market. So it takes some time for them to be willing to sell their credits, even if they believe that they are going to have a surplus by the end of this year. So we face this not a small problem, that even if there be companies who are in a position to sell credits during the trading year, they may not be willing to sell. But if there are no sellers, the market will just collapse. And there we require something like liquidity providers or market makers. And I think this will be very key, one of the key factors for the success, for the real success of the pilots. I want to come back to the question that the fact that Shenzhen is going to go alive next Tuesday puts a lot of pressure on us, and we are envious of them, but envious in a qualified way. Because to my way of thinking, the success of the pilots depends not on the first set of trades, but on the 10th or the 100th. It was very easy for a market to have one of two trades and stop just there. But if you can way down the road and see that we have the 100th trade in some of the pilots, they tell you something, that the market is really running. Otherwise, it will be just a market in appearance. But even if it's just a market in appearance, I think the good news is that some of the companies are mobilized to try to get used to the idea that there will be a cap and there will be trading. And here is a learning process.
I think, David, you made a very interesting point when you said that you have some reservations about Chinese companies' hesitation to trade, because this is not part of their experience. So I guess there are certain cultural aspects behind it as well. How can we get people who have these quotas to be willing to actually trade it? You've been very silent, ladies and gentlemen, with questions. I'm sure there are some more. Robert.
I can ask one, which is perhaps a little unfair question for Dirk. Dirk, what can we learn from the New Zealand experience? My understanding is that a few years back, New Zealand set up a very open scheme where it was linked to the CERs, sort of unlimited link to the CERs, and also they allowed forestry. And initially, things went wonderfully. There were companies investing in forests and getting 22 New Zealand dollars a ton for that. And then last year, with the EU ETS price crashing, and the CER price crashing with it, these companies that had invested in the forests were then able to buy CERs to cancel off their liability, make a big profit, and be free to chop down trees. This isn't the sort of outcome that I think policymakers were hoping for, and it's a sign of the risks if one has very open linking. So I personally have some doubts about linking. Just as I wouldn't vote for having a single global currency. You see the problems Europe's having with the European EU, the European currency, Euro, sorry. So how, going forwards, do we learn from the problems that the New Zealanders have had so that for the carbon markets we don't repeat them?
It's probably a broader question than even New Zealand, but I take your point that there are particular aspects of it that have played out in New Zealand that are sort of unique to that circumstance. One of the areas that we've been giving some thought inside AIDA is around whether there should be some, and it ties back to a point David made earlier around fixed targets. Typically, we've liked absolute targets because they're nice and clear and you know what you're working with from the outset. But when you get hit with the double whammy of a major recession, like has happened in Europe, and other unforeseen events, one of the things that exacerbates the EU price is that for all good reasons, you have feed-in tariffs, renewable subsidies across the European Union that don't have a market adjusting price. So carbon adjusts, but the renewables targets don't. So right now you continue to have in parts of Europe, again, for good reasons, renewable programs that are continuing to perform at scale while carbon sort of takes the brunt on the price side. So those programs aren't really well coordinated. I think there are a lot of things in this that we're going to learn from, and looking back at the EU ETS and its ripple effect across global markets. And part of it may have to do with were limits on CER is a good idea on how much you allow in. That certainly relates to the amount of ambition coming in at the beginning. We as an association didn't actually like CER limits, but over time I think people were willing to accept it, especially when the US pulled out and a big part of the demand disappeared. But back to the example of target setting, one of the thoughts is around, maybe you should have some governors on both the supply side and the demand side so that you understand what bands one should operate in. The Australian program has a form of that with a 5-year rolling average that adjusts targets gently over time that I think is getting more attention. So you'll notice I'm not directly answering the New Zealand example because I don't know if I have the answer for it yet, but I do think as you take the long view about the ultimate ambitions that policymakers have set out for themselves, my suspicion is that we're going to need all of these supply lines possible and that you are going to want that connectivity. But if you have a system that is more coming together in fits and starts, some of these rough edges come out, and I think that's really what we're dealing with in the New Zealand example as it sort of relates to the broader Kyoto architecture.
Yes.
Adam Kirkman from AP Capital. We've had a lot of discussion on the panel, which I think has been fascinating about where sort of the regulated markets are sort of heading. Perhaps a comment from yourself, Dirk, or maybe even Philippe as well. In relation to the voluntary carbon market, given what's happening with the European system, a lot of projects that might have originally been looking to sort of sell and generate CERs for the European system, starting to see projects, increasing number of projects registered on the voluntary markets. What role do you see the voluntary market continuing to play over the next, say, 3 or 4 or 5 years, as David's been suggesting, the experimental work in China continues? What role does the voluntary market got to play in terms of providing useful signals for the direction in which the regulator?
So voluntary markets actually grew last year, unlike the compliance markets. They grew, I think, by about 4% in a recent report by Ecosystems Marketplace. And it is an area that I think is attracting attention in part because of desires of corporates to offset as part of their corporate social responsibility, and also just interest from regular consumers, which is a healthy thing. The challenge of voluntary markets has been, particularly in parts of Europe and elsewhere, that there haven't been all that good of quality standards for unsophisticated investors to understand what they're dealing with. So there have been some really horror stories in the UK associated with it. We as an association have recently acquired or merged with a sister organization called ICROA, the International Carbon Reduction Offsets Alliance. And what that organization exists to do is to set a code of practice for companies engaging in selling voluntary credits to abide by so that we ensure quality. And I think that's a very healthy development and something that I hope more companies utilize, is to buy according to a standard like that. As part of it, it also defines what credits are deemed or in essence, what types of credit standards it deems acceptable. So the VCS and the gold standard and the CDM are all sort of part of that. We've begun to see a little bit of a blending of compliance and voluntary markets, as some voluntary providers are selling what have been approved as CDM credits through voluntary markets. So I do think there's still some growth potential, but I personally look at it and also think that it kind of ties back into the pre-compliance world of companies that are interested in getting engaged and getting some experience and actually getting themselves into a position for when compliance hits, that they'll be more ready. But ultimately, I think my suspicion is that the voluntary market continues to be a segment, but that compliance markets will always be the dominant one. But I do encourage people to take a look at the ACROA standard, because I think it has a lot to offer.
David, Philippe, any comments on voluntary markets?
Certainly, I think, it's much healthier to talk to your operating companies about a $5 or a $6 or a $7 a ton carbon price than $1 or less. So from that perspective, we use that to engage. It's really much more of an internal tool. Energy efficiency programs allows us to introduce this notion of sustainable cost accounting. There is a value to energy efficiency investment today. We can reflect that in a carbon credit which we can generate. How we use that, maybe it's just internal for the time being. We're experimenting with a methodology around internal cap and trade within the group. It's absolutely designed to make sure people are comfortable when we move into that compliance market. So we think it's really important. It keeps people very familiar with the opportunities there, and clearly a learning path towards compliance.
Well, I think the voluntary market is a good complement to the compliance market. But so far as China is concerned, the voluntary market in China remains small, I would say. The NDRC, the central government, is trying to foster the development of the voluntary market by promulgating regulations, promulgated already last year. But still the issue, the challenge, is demand. Voluntary demand within China is dismally small. And the ultimate solution to the demand problem is to link CCERs with the pilots and eventually national market, but effectively turning the CCERs, this kind of asset, into a compliance instrument. That will be the future, I would say the only future for CCERs in China. Now, as for the rest of the world, I believe that the voluntary market serves a very important purpose by raising consciousness and promoting environmental integrity. But we also see that the voluntary market has a very different function from the compliance market, namely that people look at credits not only from a carbon emission reduction perspective, but also for other related factors, for instance, poverty alleviation. So one ton is not one ton in the voluntary market. There's a great fragmentation of the market. And compare with compliance market, which can effectively honor the principle of one ton as one ton, is more a fertile soil for financial development. I would say in the future, we should focus on the compliance market within China and hope that CCER will be accepted by the international community as one possible instrument for voluntary, say, carbon neutrality in the rest of the world. And that's what I want to say.
One last question.
David Schill. Yeah, I did some work over the last few years helping the Carbon Disclosure Project around the region, which was an open platform for corporates to provide data on their carbon emissions and carbon energy efficiency programs and so on for investors. And I did work also with, as related to that, with the last 4 years with corporates in Taiwan in particular. Many of them, as a result of their Carbon Disclosure Project, started to provide information on initiatives that they felt they could get carbon credits for as part of their reporting, right? So just listening to what you were saying, David, about one of the challenges is the verification, it's the education of the corporates who are going to get caught up in this scheme later on down the road. Do you think there is an argument for some sort of internal but perhaps more open platform for corporates to, in China, to start to be encouraged to disclose their carbon emissions? Because what I found is that for those corporates that did it, it was a very, very strong educational program for them, and it helped them to better understand this market so that, you know, it helped them to see not only the challenges of it, but also the opportunities, and it would help to make them more easily sort of engage with your sort of exchange initiatives later on. Thank you.
Well, foreign companies and companies that are listed in one of the stock exchanges around the world aside, it's very difficult to convince Chinese companies that the first mover will not suffer. It's very difficult. Let me tell you this story. Actually, the Tianjin Climate Exchange was born out of a marriage between CNPC and Chicago Climate Exchange, Dr. Richard Sanders' brainchild, back in 2008. In 2009, we tried to launch a program called Voluntary Enterprise Market, something like that. We tried to, I would say, replicate the Chicago model in China. We tried to gather a number of large emitters and voluntarily create an accord and set a cap among themselves, and then voluntarily create a market that's cap and trade. Eventually, they encountered insurmountable difficulties, which leads to a silent dying of the program. But this is a very good lesson for us. It's very difficult to create this kind of voluntary initiative within a market environment where SOEs dominate, and it's very difficult to convince the first movers that they will enjoy not disadvantage, but advantage. So I believe that in the future, many of the companies in China, especially the local companies, domestic companies, will try to follow the guidance of the government. So if the government wants to build a national market and move forward with MRV issues, issuing methodologies, guidelines, and encouraging companies to first do internal inventories, and secondly, when the time is mature, to disclose the information, believing that they are not going to suffer from any disadvantage, domestically and internationally, that will be the right time for this to do. So very unfortunate, a piece of bad news for CDP.
Well, if I can just very quickly round up on just a few points. I think everybody has basically said that emissions markets are here to stay. And in fact, at the end of Richard Sandor's talk, he reminded us about water. And of course, at the beginning of his talk, he reminded us again that emissions markets actually started with sulfur. But very much we're focusing on climate, we're focusing on carbon in developing these markets. And the history hasn't been very long, but it's certainly spread very wide. And people who are working on these markets are in fact extremely ambitious. In China, and obviously in many of the places that have already started trading, the participants have had to spend considerable time and effort to get their data right and to understand what the data actually says and what you can do with it. Now this is coming to our home territory. In China, there are now lots and lots of enterprises, because of the national pilot scheme, are having to go through all of that. So I'm sure what comes out of it will be very useful, and the national ambition to create some kind of a market, I think it's a fairly clear marker for us to work towards. So thank you very much for joining us. We have three similar but different perspectives from people obviously sitting at different desks. And again, in Hong Kong, whilst we ourselves are not very active in this, I think somehow Hong Kong is going to be pulled along because all of you are here, especially now since the national effort is ongoing and our neighbors are doing something. So thank you very much. Please join me in thanking the panel, including Dr. Sandor.